So today we begin our revision, and we are beginning looking at the paper that was done last. That is the paper of December 2005. The paper of December, 2025. And we start with question number 1. That's where we begin our revision. And the first question is asking, explain the limitations of just-in-time. Limitations of just-in-time. Limitations of just-in-time. Now, remember, we say just-in-time is a method of inventory controls and is a situation where you order goods or materials so that they arrive to your premises exactly at the time when you need to use them. And you also produce goods so that they are completed exactly at the time the customer is ready to correct them. So if those two things work, JIT then guarantees you that there is no need for storage. So it is able to remove the holding cost. Now, if that is the case, it then means that you have a lot of advantages because all the holding costs are removed. But it has some limitations or some problems that we mentioned. Number 1 is that it is supplier dependent. It is supplier dependent. It is supplier dependent. Now, when we say it is supplier dependent, we mean it depends on timely deliveries of the supplier. And if the supplier misses out, we are likely to have a problem. And because of this, there are risks of stock out. Risks of stock out and idle time costs. Idle time costs. In case this person delays, you find that you are not able to meet the demands that your customers have in good time. And when you're not able to meet those demands, you will now be accused of stock out. And then you will also have your staff being idle because you told them to come at 10 so that they could work on the project or on the product. But the guy has not delivered by 10. He's coming around 1. So from 10 a.m. all the way to 1 p.m., your people have been idle. Then another thing is that it creates reduced flexibility. It creates reduced flexibility. When you rely on JIT, you find that there is reduced flexibility. You can only stick to what we call a sudden expected demand. Rather, you can only rely on things that are well planned. But in case there is any unexpected change, then you find there is a possibility of being disrupted. And that also brings what we call supplier chain disruptions. It is subject to supplier chain disruptions. There are many disruptions that can happen around the supply chain, and you find that you are not able to deliver what you expected to deliver. So those are some of the problems that we cited when we covered just in time. Let's go to part B of the question. Part B of the question. Part B of the question says, Kisasa Electronics Limited manufactures cameras and video equipment from high-end users. The company uses life cycle costing and target costing principles to produce the world's smallest and lightest camcorder with superior recording capabilities. The following summary of the information has been presented by the management accountant. Projected life cycle sales volume, 3,000 units. Target selling price per unit, 8,000. Target profit margin, 30%. Projected total cost based on linear regression analysis on product life cycle in present value terms are as follows. We are given the cost object, the cost behavior. Then we are given all that. Now, using target costing approach, compute unit cost gap for the product. So the question is on target costing. We covered that. Is on target costing method. The question is on target costing method. Target costing method. And the examiner is asking us to compute. The examiner is asking us to compute something called cost gap. So we begin there by saying that cost gap is given as the actual cost minus the target cost. That's how we get the cost gap. It is the actual cost minus the target cost. Now, how do we get target cost? Now, target cost is the selling price, the market selling price, minus the desired profit. It is the market selling price, you minus the desired profit. Now, this one tells us that when we go up there, we find that the target selling price is 8,000. The target selling price is 8,000 and the margin is 30%. So profit is 30% of the 8,000. So if you use your calculator, you are able to establish 8,000. You are able to establish that the target cost is 5,600. 5,600. That's the target cost. Then from there, you come and assemble the actual cost. So the actual cost, we are told X is the sales volume. So we will have research and development costs. So we start with research and development costs. So research and development costs, we are told is 3 million plus 300x. So it is 3 million plus 300x. And we are told that x is 3,000 units. X is 3,000 units. So I will talk of 3 million plus 300 times 3,000. I get 3,900,000. Get 3,900,000. Then I come to design phase costs. Design phase costs. So the design phase costs 2 million plus 250 plus 250 times 3,000. So this will be given as 2,500,000 plus 250 times 3,000. It is 3,250,250. Then I come to production expenses per unit. Production expenses. Now production expenses, it is 1610 per unit. So it will be 1610 times 3,000. 1610. So I get 1610 times 3,000. 4,830. 4,830. Then there is marketing and advertising expenses. Marketing and advertising expenses. So marketing and advertising expenses. Marketing and advertising expenses. It is 980 plus 20. 980. So it is 980,000 plus 20 times 3,000. 1040. 1040. Distribution and delivery. So distribution and delivery. Now the distribution and delivery is 1 million plus 100. So this is going to be 1 million plus 100 times 3,000. That's 1,300,000. Then we have customer care services. Customer care services, 1205. Is it? No, yeah, 1205. Plus 375,000. 375 times 3,000. So this now becomes 1205,000 plus 375 times 3,000. 2330. 2,330,000. Okay, so we are done. So we get the total. Total actual costs. So this total actual cost we add from here. So If I add backwards, I add 1.3, then I add 1040, then I add 4830, then I add that 250, then I add 3900. So it's coming to 16,650,000. 16,650,000. Then unit actual cost. Unit actual cost. It is this 16,650. You divide it. You divide the figure by 3,000. So you divide by 3,000 and you get 5550. 5550. And thus our cost gap. Our cost gap should be the actual cost, which is 5550 minus the target of 5600. So minus 5600. So there is a gap of 50. What that means is that the company is shortchanging the customers. They are incurring a smaller cost than what they should be incurring. Therefore, they need to go back, look at the contents or the components of their production cost and upgrade so that when they are selling to their customers at 8,000, they give them a product that is worth 5,600. Yeah, so that is how it is done. Good. Let's now go to part B of part C now of question 1, which is telling us that Junction Cafeteria buys and sells hot takeaway food. The cafeteria wants to decide on how many burgers to purchase for sale at a forthcoming outdoor concert. The number of burgers sold will depend on the weather conditions, and any unsold burgers will be thrown away at the end of the day. Will be thrown away at the end of the day. There is 30% chance that the weather will be good, 20% chance that the weather will be normal, and 50% chance that the weather will be bad. The table below shows the profits that would be earned for each possible outcome. Now, you are required to get the number of burgers to purchase to satisfy those rules. Now, this question is on something very, very important as far as your examination is concerned. I told you decision making is very, very important. Decision making, it is very difficult that there will be no question on this area. It is very difficult that the examiner will miss to examine on this. And if you refer to your notes, this is a question that is on what we call single stage decisions. Single stage decision making. And in single stage decision making, or when making decisions, I told you there are several things that you need to pick. The first thing, you need to know what is the objective. What is the objective? Now, objective is what you want to achieve. Objective is what you want to achieve. Now, if you look at the subject of this question, we are told it is a canteen. And this canteen, we are told they are selling. So even if they have not mentioned anything else, as a business person, you need to know that people buy and sell so that they can maximize profits. So the objective here is to maximize profits. That one should be well understood. The second point that I told you should always be very, very clear is what are the alternatives or what are the options? What are the alternatives or the options that are available? Now, we said this is what is beyond, or rather, it is within. This is what is within control of the decision maker. Now, in this case, the decision maker is deciding. Actually, the second sentence says the canteen or the cafeteria wants to decide on how many burgers to purchase. So the question is the purchase units. The purchase units. And these purchase units, they are deciding on 4 of them. They can buy 1,000, 2,000, 3,000, 4,000. Yeah. The third and very important is to know the outcomes or what we call the states of nature. And I told you the states of nature are described using probabilities. The states of nature are described using probabilities, and they represent that which is beyond you. That which is beyond you. In our case here, what is beyond the canteen operator is the issues of weather. The issues of weather. Those ones are beyond their control. Now, from there, you now decide the type of the decision. We already know the type. And then you compute the payoffs. You now compute the payoff. You compute payoffs. And we said payoff is the revenue minus cost. Payoff is the revenue minus cost. Payoff is the revenue minus cost. Higher. Then from there, you prepare a summary. And if you are using, if you are in a single stage decision, we use what we call the payoffs table. The payoffs table, which already has been done for us here. But if you are using, or if you are making a multiple stages decision, we use what we call decision tree. Now from there, you select the preferred option. You select the preferred option. The preferred option. Now here, you select the preferred option using appropriate rule. Using appropriate rule. There are many rules that we came across. And some of them have been highlighted here. So let's have the payoffs table. Although in an exam it's not a must you draw it because it's already drawn for you, but I wish to redraw it again here. The payoffs table. The payoffs table. Now the payoffs table is drawn like this. There we have the details. We have the first option, the second option, third option, the fourth option, and then the probabilities. So we normally draw it like this. So this is where we have the options. And the option, we are saying it is to purchase the burgers. You can purchase 1,000. You can purchase 2,000, 3,000, 4,000. And now we have the probability. The outcome of the weather is it can be bad, it can be normal, it can be good. Those are the outcomes. So the values, when we are in 1,000, and the weather is bad, we have 1,000. The weather is normal, we have 3,000. And good, we have 3,000. When the weather well, that was for 1,000. Then for 2,000, when the weather is bad, we have 0. When the weather is normal, we have 6,000. And 6,000 here. When we go to 3,000, we have minus 1,000. We have 7,000. And we have 9,000. When it's 4,000, we have minus 3,000. 6,000. And 12,000. The probability of the weather being good, is 0.3 here. The probability that the weather will be normal is 20% here. And the probability that the weather will be bad is 50%, 0.5. So with that in mind now, the first thing that we are told to use is maximum of the max-min criterion. Max-min criterion. So using max-min criterion, we normally get the option here, and then we extract the minimum payoff. So for 1,000, for the option of 1,000, if you walk around here, this, the minimum payoff is this one. So you take 1,000 as the minimum payoff. If you come to this one of 2,000, the minimum payoff is 0. If you go to this one of 3,000, the minimum payoff is minus 1,000. And when you come to this 4,000, the minimum payoff is minus 3,000. So with that now, what you do, this rule says, select the maximum of the minimums. Select the maximum of the minimums. The maximum of the minimums. So when you select the maximum of the minimums, you take this one. So the advice that you are going to give is that they should purchase 1,000 burgers. That is the advice that you should give, that they should purchase 1,000 burgers. $1,000 burgers. Higher. The next rule is max criterion. Max criterion. Max criterion. Now, with the max criterion, you are going to have the option here, and then you get the maximum payoff. The maximum payoff. So with 1,000, the option of 1,000, the maximum payoff is 3,000. You come to 2,000. When you come to 2,000, the maximum is 6,000. You go to 3,000. The maximum is 9,000. You come to 4,000. And you find the maximum is 12,000. The maximum is 12,000. So now, this rule says, select the maximum of the maximums. So the maximum of these maximums is this one. The maximum of these maximums is 12,000. So the advice that we are going to give is that they should purchase 4,000 burgers. They should purchase 4,000 burgers. We should purchase 4,000 burgers. And then minimax criterion, I'll just change here for myself. And I say minimax criterion min-max criterion. You draw another table like that. You draw another table. That way. Okay, so this says you select the minimum of the maximums. You select the minimums of the maximum. So the minimum is this one. And therefore we are going to advise, that they should purchase 1,000 burgers. They should purchase 1,000 burgers. Okay, so I think that is good. Now, the next thing that we need to look at, is question number 2. And question number 2 says, the management accountant should carry out risk assessment and disaster preparedness when accounting for environmental costs. This is as a result of dynamic environmental changes and government compliance requirements. Now, analyze 3 interventions to implement and to take to minimize the impact of dynamic environmental risks and internal failure costs. The dynamics of internal failure risks. Now, the first thing that we need to remind ourselves, we have what we call types of environmental costs. Types of environmental costs. Types of environmental costs. Now, these environmental costs, there are usually 4 of them. I will give you some more notes. You can go look at them. Now, the types of environmental costs that we have, one is called prevention costs. Is called prevention costs. Now, these are the costs that you incur to ensure that there is no pollution. These are the costs that you incur to ensure that pollution or you do not degrade the environment. Then we have what we call the detection. The detection or monitoring costs. The detection or monitoring costs. These are costs that now we incur to find out any pollution that has already happened. To find out any pollution that has already happened. Then we have what we call internal failure costs. Internal failure costs. Now, internal failure costs, these are the costs of fixing the damage that already has happened. When we have monitored, we have detected, and we have found out that there are costs that have already, or there are damages that have taken place in the environment, then we need to fix them. So that is part of internal failure costs. The number 4, we have what we call external failure costs. External failure costs. So the external failure costs, these are costs that affect the society, the environment that we are in. So those are the 4 types of costs that we normally have. So now the question is asking us, the interventions that can be done. The interventions that can be done. The intervention that can be done to failure costs. Now we have several interventions. One of them is preventive and predictive maintenance. One is you can have predictive and preventive maintenance. Predictive and preventive maintenance, you can be able to use that. Number 2, you can do what we call the total quality management. Total quality management. Total quality management. Total quality management. You can be able to do that. Number 3, you can also be able to do what we call automation and process control. Automation and process control. Automation and process control. Number 4, there is something we call training and competency development. Training and competency development. So you can train your people on some of these things so that they do not incur a lot of failure costs. Hey, sorry, I was preparing those notes so that I'll be able to give you, you can look at them in a more detailed way. Now, let's proceed to part B. Now, part B is saying one of the functions of management accountant is to generate confidential reports for strategic internal decision making. However, most of these reports are fraught with integrity issues, such as conflict of interest, creative accounting, and lack of credibility. Now, with reference to strategic management accounting information, explain the following, the meaning of the following ethical standards of accountants. Now, when we talk of ethical standards, we are talking of the expected levels of behavior, that accountants should exhibit, that management accountants should exhibit. And you know from our notes, we discussed 4 ethical standards. Number one, we talked of competence. We talked of competence. Now, competence has to do with the qualifications, the academic qualifications. Before you go telling people that you are a management accountant, you need to have passed the requisite examinations and you are registered with the ISPAC. And then you must have what we call continuous development. Number two is called confidentiality. Confidentiality. Now, confidentiality, it is the ability to keep secrets. When you come across confidential information, information that we call classified, you should keep quiet. You should not go disclosing to people that are not supposed to know at that time. The next one is integrity. Now, integrity has to do with good behaviors, good manners, the expectations that you should exhibit. And then there is what we call credibility or objectivity. There is credibility. In our notes, we call it objectivity. If you refer to our notes, you see that credibility or objectivity. And those are the 4 standards that are required. So now, the examiner had required that you explain the meaning of these 2. You explain the meaning of these 2. And I think I've already highlighted, but I'm going to give you again a summary, or rather more detailed answers. And this is now in response to question 2B. Let me specify that. This is question 2B. Question 2B. Okay, so I will be giving you these notes so that you can also get them in details. Let's go to part C. Part C says, Jikon Limited is a manufacturer of edible vegetable oil, branded soya oil. The company uses 3 basic ingredients to make soya oil. The standard data for a liter of soya oil is as follows. Standard cost per unit of soya oil. We have the ingredients, the standard mix ratio, the selling price per liter. A standard loss of 10% is expected in production. During the month of March 2025, the actual output was 92,700 liters of soya oil. The actual quantities mixed and actual costs were as follows. So you are told to get the following variances. This question is very similar to the one that we solved in class. Very, very similar. It is on what we called standard costing and variance analysis. It is on what we called standard costing and variance analysis. Standard costing and variance analysis. This is also another area that you can bank on. The probability that your paper will miss a question on this area is very low. The examiner is known to like testing variances so much. Now, in our analysis here, we need to first of all get the standard mix, and then we get the output. So the standard inputs in units. The standard inputs in units for alpha, we can convert them into in units. So we have 50, and then we have 30, and then we have 20. So the inputs were 100. You can look at them that way. That would be the easier way. Then the standard costs of inputs will now be given as 50 times 70. 50 times 70 plus 30 times 50 plus 20 times 20. 20 So when you work out those computations, you'll be able to tell me it is 50 times 70 plus 30 times 50 plus 20 times 20. So this is coming to 5,400. 5,400. Higher. Then the standard yield. The standard yield should be this 100, the input, minus the normal loss. The normal loss, we are told, is 10%. So that means we are going to get 90 liters. So with that, we can be able to get the standard unit cost, the standard unit material cost, the standard unit material cost. So we input 5,400. You now divide by 90 so that you get to know 1 unit of the input. 1 unit of the input was to cost us how much? And this is giving us 60 shillings. That is giving us 60 shillings. Haya, then tukikuja hapa chini, we need to analyze the actual quantity used, the actual inputs. the actual inputs in units. The actual input in units, you can see there is 53,000 plus 28,000 plus 19,000. Now, if you add those ones, you say 53 plus 28 plus 19, you are able to get that it is 100,000 liters, obviously. And then the actual cost of inputs. The actual cost of inputs. We just add those costs because they are given as total 3710 plus 1484 plus 418,000. So with this 3710 plus 1484 plus 418, 5612. Yeah, 5612. So the first question is asking us material price variance. So material price variance. So material price variance is given as standard price minus actual price, you multiply by actual quantity. That's the formula of getting material price variance. Is the standard price minus actual price, you multiply by actual quantity. So when we start with alpha, up there, now that this examiner has given the total cost, this formula, I can also open it like this. Let me open it. It is the same thing as the starting price times the actual quantity minus actual price times the actual quantity. It's the same thing. So when I come now to material alpha, the standard price up there is 70. And the actual quantity of alpha is 53,000. And the actual cost is this one, 3710. So I'm going to have 70 times 53,000 minus 3710. Oh, that would be 0. So that one did not have a variance. Higher. Let me go to the second material, which is called beta. Now beta, the starting price is 50. And the actual quantity is 28,000. Minus the actual cost. The actual cost is 1484. So I will talk of 50 times 28,000 minus 1484,000. So it is negative 84,000. So that is adverse because you can see this is more. So for beta, we had more. Then for zeta, it is the starting price is 20. And the units were 19,000. So you minus the actual cost of 418,000. That is 20 times 19,000. You minus 418,000. That is also so the total of those three, the total is 3,000. No, is 0 plus 84,000 advance. You can either recognize the sign or you ignore it, whichever way, but you must ensure you have labeled. You must ensure you have labeled accurately. You have labeled accurately. So this comes to 122,000 advance. 122,000 advance. That's the material price variance. Okay. The next one that we are supposed to compute is material usage variance. Material usage variance. Now, material usage variance, the formula, material usage variance is standard quantity minus actual quantity. You multiply by the standard price. You multiply by the standard price. So for alpha, the standard quantity is given like this. Now, alpha, we were supposed to have used 50 for us to make 90. For us to make 90. So that tells you 1 unit of our output was supposed to use 50 out of 90. Then you now multiply by the actual quantity that we had here. Sorry, not the actual quantity. You multiply by the actual output. The actual output is 92,700. That will tell you how many liters we should have used. How many liters we should have used. You minus the actual liters that were used, 53,000. You multiply that by the standard price of 70. Multiply by the standard price of, so this will be 5. I minus 53,000. So I used more times 70. So this is 105,000 advance. I told you you can write the negative or you can ignore it. But what is more important is the ability to label. That variance. Next, we have beta. Now, beta is also the same case, this 30. out of our 90 times 92,700 minus 28,000 times the price. The price is 50. So this is 3. You minus 28,000. So that is positive. So times 50. 145,000 favorable. Then we have zeta. Zeta, it is going to be 20 minus 19,000 times 20. So this will be 2 out of 9 times 92,700. You minus 19,000 times 20. This is that 2,000 favorable. So the total of this is 105,000 adverse plus 145,000 favorable plus that 2,000 favorable. If you combine them, you get 75,000 favorable. No, 72,000. 72,000 favorable. Material mix variance. Material mix variance. Material mix variance is given as revised mix minus actual mix. You multiply by the started price. So when we start with alpha, the mix is this one, 50 out of 100. You multiply by the actual quantity. The actual input was 100. You compare with what we input, 53,000. You multiply by the starting price of 70. So this will be 3,000 That gives us 210,000 advance. We used more. We used more than what we should have used. We used more than what we should have used. Then we have better. This is 30% minus 28,000. And the starting price is 50. So we use less because this is 30,000. So there is 2,000 times 50. 100,000. Favorable. And then zeta. Zeta is 20%. Minus 19,000. Times 20. So even here we use less, and this was 20,000 favorable. So the total is 210 plus 100,000 favorable plus 20,000 favorable. So this is 20 plus 100. That's 90,000 advance. And finally now, material yield variance. So material yield variance is given as standard yield minus actual yield. You multiply by standard unit material costs. And I told you yield is argued like this, that when we put 100, we got 90 out. So now that we had put 100,000 here, we should have gotten how many? So that is our standard yield, which now will be 100,000 times 90, you divide by 100. You divide by 100, then you minus what we actually got. We got 92,700. And the standard unit material costs, this one, 60. So this we were supposed to have gotten 90. So we got 2,700 excess. And this is favorable. It's favorable. We got more. It's favorable. We got more. So thank you very much. We call it a lesson at that point. We will pick up from there in our next lesson. Thank you.